All right, folks. Thursday, December 27th, market staged a very nice comeback today. So yesterday we were up 1,085 points in the Dow. That was the largest single day gain in history. Today the market started off on the defensive. The selling emerged early. Took us down to 600 down on the Dow by late in the afternoon, and then it turned around and we closed up 260. So another good day where the selling was pushed back and the market closed up on the day. So that's very important. I don't think we've seen 2 days up in a while, so it's good to see that. And I would expect, barring any further developments, that we are in the process of turning this thing around. Yesterday I spoke about valuation on the market. The market's forward PE now down below 14. The S&P's forward PE below 15. That's the lowest in 5 years. That equates to about a 7% earnings yield. When you're looking at comparative returns on fixed income, on bonds, 2.5%, 2.6%, something like that. A 1-year treasury bill or a 2-year note, around 2.6%. So a very decent gap favoring stocks. And many stocks now have been so beaten down. I mean, I just sent out an email today about one in particular, a very well-known chip stock, technology stock, semiconductor, trading at tangible book value. I mean, those are the kind of bargains you want. So you have that. The other thing I want to talk about, by the way, through this whole entire thing, our gold positions have been performing very nicely. Haven't mentioned that recently, but I thought I should mention it. I want to talk about volume, market volume, and the way that I look at volume. I know a lot of people have a sort of rote way of considering volume. They say if the market moves up on light volume, that's bearish. If the market goes down on light volume, that's bullish. Volume has to support the move. And my view of volume is that volume is a measure of urgency. How badly do people want to get out or get in? How quickly do people want to get out or get in? And urgency, to me, is a sign of emotion. When there is haste, when people react very quickly without any reflection, when it is in big size, which is volume, that tends to portray a kind of a herd-like behavior, a stampede. That's the way I look at it. You know, markets can rise on low volume. There can be periods of complacency where stocks or commodities can go up or down, and it doesn't really touch off any significant concern or interest. And then it might hit a certain point where that volume comes in big time, and that is a sense of urgency. Maybe the market has been going up for a while on quiet volume and then breaks above some technical level, which causes stops to be hit and people wanting to exit, or others who see that as a level where it confirms their bullishness and they want to get in. So I look at volume as a measure of urgency, and in general, I like to go against high levels of urgency, because when people act like that, it signals to me that they are acting emotionally or under some kind of stress. And when you're under stress, you tend not to make good decisions. So that's how I look at it. Now, sometimes a move on volume does signal a continuation in the same direction. For example, if a market has been quiet and maybe going sideways for a long period of time, and then suddenly breaks out in one direction or another with big volume, that could be an indication of a continuation of that move or the beginning of a major move. So you have to be, I think, flexible when you look at volume. You have to consider the circumstances and the market environment and basic conditions surrounding whatever that market event or market movement was. But yeah, I mean, markets going up on low volume, that could happen. Markets going down on low volume, that could happen. That just signals complacency. People are okay with what's happening. There's no urgency. But then when it hits a certain point, you get that stampede, and that's very often a reflection of some type of stress or emotional behavior. And in general, I like to go against that. And we recently saw in this stock sell-off just a couple of days ago some really, really high levels of volume, which could signify the flushing out, the final flush out of the selling that has been occurring. And again, I go back and I will continue to say that the market has been going down for 3 months, and we have not really seen any evidence of major economic slowing. Yeah, we saw a little bit of a pullback in consumer sentiment. Some things are a little bit easier. But in general, and I've been pointing this out, if you look at major economic metrics, if you look at bank credit, if you look at loans and leases, if you look at the fiscal support that is underneath the economy, if you look at industrial production, if you look at capacity utilization, if you look at the labor market, all those things. As a matter of fact, we just had, again today, initial claims, very close to a 40-year low. There's been no uptick in that. Unemployment benefits being paid out, falling year over year. Absolutely not even flat year over year, falling, continuing to fall year over year. Loans and leases and bank credit accelerating higher. So, I mean, you had 3 months of a market meltdown, the likes of which, at least according to the media and people out there saying we've never seen this thing since the Great Depression, no reaction in the economy. So it's a correction. Anyway, that's it for today. We had a nice reversal of 600 down. We closed 260 up on the Dow. Very good sign. See everybody tomorrow. Bye-bye.